And by the time they give these people like an hour in the room and they walk in on these people, and some of these people would be like, okay, if I am scratching my head with my right hand and I am balancing on my left foot, the light will come on. And it's all feeds into that. We see patterns everywhere, and sometimes they don't exist.
All right, welcome to another episode of Money Therapy. You say your name first.
My name is Bill McGill, and we're back, baby.
I'm Brandon Chasteen. So we're both financial professionals. We work with people one-on-one and helping them to find a path to hopefully meet or exceed their goals that they set in their financial life. There's so much bleed over between our finances and just everything else that involves being human. People are passionate about their money. So much so that like financial stress can lead and present as real life physical stress, and physical stress can eat at our overall health, right? Because it's so important to us, we can get pulled in or sucked into making bad decisions or being paralyzed and making no decisions, both of which can keep us from really getting to where we want to be in life.
It's all intertwined.
It's an ecosystem. So again, money therapy. If you've been listening to us, we do appreciate it. And you've probably heard us say this 100 times. If this is your first time listening, understanding the math and the data points and the science behind money it's actually pretty easy. Like for me, for Bill, like we do it every day. So understanding, how to do the mathematical inputs to figure out a reliance rate, understanding, the ratios of income and things to figure out how much can go into a SEP account or income limits to fund an IRA. These are all things that they're so important to know. Typically a quick Google search can also tell you. That's so important. The technical side of money is so important. What we have found that the hardest part of managing money has nothing to do with money, more about people.
Yeah.
So money therapy really starts to say, okay, if I'm running into these financial problems, it's probably not the data inputs. It's probably how money affects my life and how I'm being impacted by financial decisions I might have made in the past. So we really, really are trying to focus on the human being side of things, the behavioral, the mental side of money, the emotional side of money, right? So this week, we're just telling you straight up that patterns are not predictive.
Yeah, that's the topic right there.
Human beings, like we are pattern recognition machines. We grew up like there's kids' books about, and I remember like being in elementary school and like taking those like state tests, and it's like, object 1, these 4 lines are this way. Object 2, these 4 lines are this way. Object 3, and then you have the test question is pick what object 4 is going to look like.
Yeah.
Right. And we've been trained to see patterns. Sometimes we're good at seeing patterns even when they don't exist. But
that's true.
When it comes to finances, especially the investment world, we are inundated with graphs and charts and statistics. And I'm just going to come out and say it right now. Like this is a saying I've heard throughout my life. Statistics are a liar's best friend.
Yeah.
Because what we can often do is find data points that support our argument. So if I'm trying to convince you that you should, buy this car because it's the safest vehicle, I'm going to show you all the true data points that support that statement. But what I'm going to exclude from this presentation are the data points where it actually suggests that it's also a vehicle you can die in.
And especially that ejection button in the middle of the console that
right.
just throws the passenger out, right?
So patterns aren't predictive, but we fall prey constantly to people showing us patterns and us believing that because we can see this pattern happening, and last time this pattern happened, the outcome was X or this or that. Now, if this pattern is happening again, we can deduce that this will be the outcome again. And that isn't research, and it's very dangerous. I'm actually not above that. I am constantly, I find myself far too often analyzing like charts and graphs and kind of getting like buying into this notion, well, if the graph is doing this today,
Yeah.
it probably means this is our future.
Right.
That's you're reading tea leaves.
Yeah.
And there's a certain point where we give our like best effort and best intentions to research, but instead of like looking at the whole picture, we start to pick out the pieces that support the argument that we want, right? And that's a behavioral thing. Like,
Yeah, they've done so many studies on this. The one thing that comes to mind is I read a book called The Subtle Art of Not Giving a F. I won't say the actual word. But it's a great book. But in that book, he describes a case study where they had subjects in a room basically sitting at a desk, and there was a red light. And they were told that the more you can get this red light to turn on, the more points you'll get. And there's other subjects in the study, and so, get as many points as you can, right? Feeding off competitiveness and stuff. Well, what he didn't tell them, or what they didn't tell the subjects, is that the light was actually completely random when it would come on and turn off. And by the time they give these people like an hour in the room, and they'd walk in on these people, and some of these people would be like, okay, if I am scratching my head with my right hand and I am balancing on my left foot, the light will come on. And it's all feeds into that. We see patterns everywhere, and sometimes they don't exist because that light is completely random. But they will swear up and down that they can turn that light on with their behavior, with that movement. Same kind of thing that you're talking about with charts. Well, if the chart looks like this, the market's got to go up. And I always love to say, but it could go down.
Yeah. There's some other fun little statistics for you. So back when polio was becoming a very prevalent problem, there was some legitimate considered research done. Like at the highest levels, they were kind of buying into this and actually creating kind of campaigns, broadcast, news, commercials that suggested that ice cream is what caused polio.
That's nuts.
And the reason why is when they looked at a graph, polio was spiking in the summertime. And the other thing that was spiking in the summertime was the sale of ice cream.
Right.
That's from the book Freakonomics, a great book. We have some other, there was a market researcher, stock market researcher, David Lineweber. He figured out 3 statistics, 3 graphs, 3 charts that would predict the performance of the United States stock market. And that was the relationship between butter production in the United States versus that in Bangladesh, the correlation or the relationship between sheep populations in the United States and that of Bangladesh, and just the overall cheese production in the United States. Those 3 things were predictive of a positive move in the market.
Right.
The point is like when you're in my position, there are some things like, and this is for anybody that is out there, and because there are people that invest money and they look at charts. That's all they look at. We call them chartists. And there is some awareness that can be made based on recent moves in charts. So we have things like what we call cup and handles, or we have things like double bottoms or triple bottoms or double or triple tops. We have, downward wedges or upward wedge, all these things that chartists will look for. My biggest word of caution is charts can do a good job of helping you understand how you arrived to where you are today.
Right.
But the chart itself does not mean that tomorrow is going to be this, right? Just because I've been in this pattern for the past 3 weeks, could it mean that the pattern will reverse tomorrow? Or if we had 3 negative weeks, like we're actually in a third positive for the past 3 weeks, the U.S. markets have been higher each week.
Right.
So does that mean that the fourth week will be higher? Does that mean that the fourth week will be negative? Neither. It doesn't mean either.
Right.
Right. What it means is that we can look at charts and say, okay, we are here. What are some things that have happened? What's the whole picture to explain what's going on today?
Right.
I think that if you start, so I have research analysts from all these major investment platforms, big institutional money managers come in my office trying to pitch me why I should include their investments in my models that I manage.
Sure.
And typically they will come in and say, if you look at where we're at today, look at this pattern. Like we're kind of in the same situation that we were here, and this was the outcome. The biggest thing that I immediately start to wonder is this causation or correlation?
Right.
Right. Just something that, I had to research a lot when I was in grad school is, if I'm trying to write a research paper, is the data that I'm giving, is it correlated to the experience, or is it caused by the experience? So, is ice cream sales spiking when polio was spiking correlated, or was it caused by? And oftentimes what we see is correlated patterns. Like this pattern is happening, and so is this outcome, but it's not cause. So with investment people that sit across from me, they'll say, hey, we brought in this new money manager. He's been doing this, and this. This is the pattern, and this is the outcome. And it's like, okay, is the money manager making decisions alongside positive market returns, where it was just kind of it was almost like he could have made different decisions and the positive outcome still would have happened? Or did his decision making actually cause positive returns? Right. And oftentimes, like I said, 9 times out of 10 is probably a correlated thing, more so than my decisions caused positive returns. Does that make sense?
Yeah. Yeah, no, it definitely makes sense.
So in that same thought, like we see that frequently. There's another one we were talking in show prep, Dude Perfect.
Yeah.
Right. They love to do these like awesome trick shots.
Yeah.
And if you're scrolling social media, you'll see some guy like, I don't know, throw a card and get it stuck in in between 2 matches and light the matches or whatever.
Yeah.
Some really cool stuff.
Yeah.
But what you're not seeing is the 3,000 attempts that he made before that.
Right.
Right. So another kind of in the same vein between the cause, like start questioning, is this causation or correlation? Did it happen because of this pattern, or did it just happen and the pattern exist? Another thing that I often say is, like shoot it again. So if somebody comes to me and says, hey, our money manager has made this change, they made this decision, and this was the outcome. I'm like, okay, well, show me twice. Did he get lucky? Was it just a correlated happenstance occurrence? Or did he actually do this? And can he or she repeat this again and again and again?
Yeah. This reminds me of our conversation a couple of weeks ago. We were talking about mutual fund managers and their performance against the stock market. So to go a little bit, more specific with our metaphor here, and the 5-year number, the number of, in a 5-year given period of time, how many managers outperform the stock market, it was like 20%. If you looked at 10 years out, it was like 10%. And then if you looked out 20 years, only 5% of mutual fund managers out there actually outperformed the market. So in our example here,
they shot it 20 times and did well.
Yeah, and the next step, well, in the short term, it may seem like a pattern. Like, oh man, this is going to keep happening. We're going to keep outperforming the market. But as time goes on, you realize maybe this isn't a pattern. Maybe this is, fewer and fewer people are outperforming the market. So I think kind of the next step there is to take a step back from that, ask yourself the correlation causation question, which allows you the moment to step back and to really look at it and ask yourself, okay, if I'm going to make an investment decision, why am I making this investment decision? Am I buying into GameStop because that's hot right now and we're going to go up against the hedge fund guys? What is there actually a pattern there? And how can we objectively look at a situation and try and figure that out?
Yeah. So I think the biggest takeaway, and I guess the purpose here is just saying that oftentimes we can be presented with things that allow us to have this inclination that we can see in the future. And we cannot see in the future.
Right.
We can do all the research that we possibly can do. We can do all the homework that we possibly can do. But it does not necessarily allow us to know what tomorrow holds.
Right.
Right. There are times that I make decisions about like major shifts in things. I think, you could look at like major human kind of society shifts. We're kind of going through this transition of energy and our reliance on energy and our reliance on certain types of energy versus other. Like all this stuff has changed, an evolutionary process. That does not mean that, a battery powered car stock will take off tomorrow.
Right.
Right. We could look at trends and say, hey, people are starting to live longer. Right. Which would, if we are living longer on the backside of life, in the late stages of life typically have a lot of healthcare cost. So if more people are living longer and they're in that elevated time frame of life that is higher healthcare cost, could that mean that healthcare will make more money over time? Potentially. It does not mean that a healthcare stock is going to jump up tomorrow, right? So we can trends versus patterns.
Right.
And what are we actually trying to do? Are we trying to be intelligent and well-researched in our investments and choosing investments that support our goals? Or are we saying, hey, somebody's showing me, this pattern that's happening over the past 3 months, and if I get in right now, I can 10x my investment.
Yeah.
And that's really the danger. So patterns, you have to know. I think that's just a card to keep in your back pocket. Patterns are not predictive. And when you get that stock tip or that investment idea that's suggesting like now is the time, because it could make sense. It could even be true, but it does not, and it should not give you some false sense of security that tomorrow the outcome will be this, or next week the outcome will be this, because of this pattern.
Yeah. That's
dangerous.
Yeah. On a micro level, you just shot this into my brain. When we're dealing with clients sometimes and we're looking at individual stocks, I'll go kind of specific and then broaden it back out to our point in that, when you're looking, if you bought a stock and it's been performing a certain way over a certain period of time, the conversation I'm always having with clients is every day that you keep that investment, we can call it a stock, whatever it is, you're choosing to buy that investment again because you haven't sold it, right? So another way of looking at it is tomorrow, if you still have it, you've chosen to buy it at that price for X, Y, and Z reasons. And what that does is, again, that allows you to step out of it instead of going, hey, man, Enron's been a great stock for the last 10 years, and it's just going to keep going up. I would suggest maybe you're starting to see a pattern that may not be there. The pattern may be there, but to have that second of clarity to say, hey, let's kind of pump the brakes here and actually analyze this stock and say, okay, I have this healthcare stock, and I'm seeing these different trends and these different patterns in the economy. Population's getting older. Healthcare costs are probably going to go up. Again, we're making an educated guess on that. But that doesn't mean, okay, people are getting older, so then electric car sales must be going to be taking off. So you got to be careful how you analyze things. And again, this thought experiment hopefully helps people realize that you can take a step back and objectively look at something and make a decision going forward, not necessarily everything that's happened in the past, but it allows you the opportunity to get out of that pattern mentality, and that the fan bandwagon, if you will, for particular investments. And so I think that's a big big thought in what we're talking about with that correlation causation. You got to be careful.
Yeah. So I think we'll wrap up because I have basically 3 patterns that I support, and I actually would encourage you guys to internalize these patterns, because I can get behind every one of these. So
butter sales,
no, not butter sales. The 3 patterns that I would promote that we focus on, and so when somebody comes to you and says, "Hey, check this pattern out. Now's the time to invest in X, Y, or Z." Instead, I'm asking you, can you, one, break a pattern that is buying high and selling low? Yeah. Something we all do, or we are all inclined to do from time to time, because we get fearful and we sell low, or we get greedy and we hold on to something that's higher than it should be. The next pattern is the idea of breaking the pattern of chasing the next big investment. If you can break the pattern of chasing the next big thing, you're probably going to be much more grounded, and you'll actually be able to say, "Hey, no, you're presenting something that isn't really there," right?
Sure.
And then the third and most important pattern that I would recommend for every single listener is attempting to buy low or at cost investments in a diversified portfolio based on your values and goals, and then just letting them do their job, right? That's a pattern that I can support. That's a pattern I can get behind. Low cost entry, diversification, considering time, considering risk, being really, really intelligent investors, and then not being overwhelmed by watching them day to day, right? That's a pattern that would promote financial health and well-being.
Yeah, absolutely.
All right. Any questions? Any thoughts?
Good to go.
All right. See you guys next week.
Have a good one.
Bye. We hope you learned something valuable today. We appreciate you including us in your journey towards financial betterment. It is important to us that you know this is for educational purposes only and not to be considered specific advice for any individual listener. If something we discussed is relevant to you and you have questions about how it might be uniquely applicable to you, please discuss that with a financial professional, or, of course, we are happy to have further conversations with you about your specific questions, needs, or circumstances. We welcome you to reach out to us via our website, harpethwealthpartners.com, or by emailing Brandon at bmc@harpethwealthpartners.com. Securities are offered through LPL Financial, member FINRA SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Harpeth Wealth Partners are separate entities from LPL Financial. The opinions voiced in this material are for general information only and are not to be intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult appropriate qualified professionals prior to making a decision. Investing includes risk, including fluctuating prices and loss of principal. No strategy assures success or protects against loss. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Hypothetical examples presented are not representative of any specific investments. Your results may vary. We want to thank you for your time, and we look forward to having you back next week.